Hello, good afternoon, everyone. Thank you so much for joining us for today's free webinar, Ask the VC, How to Create a Winning Pitch, with Mark Phillips from Arifura Ventures and Gadiel Morantes from Early Growth Financial Services. I'm Erica Malsberg, the Chief Marketing Officer for Early Growth Financial Services, and I'm going to be the moderator today. So for those of you who've joined webinars of ours before, this one's a little bit different. We've been trying this new format a little bit, and this is more of an open forum for questions. So we do have a slide deck here, and it's really good content that Mark has delivered before in different ways. And it's actual slides from real life pitch decks for companies that have been funded. And so we're happy to walk through this content and talk through, what makes a good slide for management or whatever it may be. But we're also happy to not walk through any of this content at all and just sit here and spend an hour taking all of your questions. So this is really your chance to ask a real live VC, Mark, anything you want to know about what VCs are looking for, what are the deal breakers, what make you stand out. And we have Gadiel Morantes on the line as well, who works with tons of clients who are in the process of fundraising, so he can give you that perspective as well, and how business partners can support you in the fundraising process. So please feel free to just jump right in and enter your questions in the open text field. And I'm just going to be serving them up to Mark and Gadiel as they come. I might lump some together. So if we don't address your question immediately, don't lose hope. It might mean that we're just getting lots and lots of questions, and we'll hopefully get to all of them. Okay. And if the questions aren't coming in, again, we'll just start going through this content and see how we go. So that said, and just last bit of housekeeping is we will be sending out a follow-up email tomorrow that's going to give you a copy of this deck and of this recording. So, if you see us sort of quickly passing by a slide that you find interesting and we don't get to talking to it today, you will have that content in front of you tomorrow that you can review at your leisure. So before we jump in with your questions, you can start entering them now, but I just want to do our quick introductions here. First of all, we're honored to have with us again today Mark Phillips. So Mark is a great partner of ours and a managing partner at Arifura Ventures, which is a Silicon Valley-based micro venture fund focused on technology startups and early stage companies. He's also the author of a fantastic book, which we always push on everyone because we think it's just great. And it's called Inside Silicon Valley, How the Deals Get Done. If you haven't already, you should definitely check it out for its great insights into the Silicon Valley startup ecosystem. And it's available on Amazon, so you can search for that and order your copy today. I'd also like to introduce Gadiel Morantes. He's our Chief Revenue Officer with Early Growth Financial Services. Gadiel is an accomplished executive with 15 plus years experience, and his vast experience working with founders and as an entrepreneur has given him great insight into what it takes to build successful companies. So hello to you both.
Good afternoon, everyone.
So before we jump in and start taking these questions, Mark, do you want to just say a couple of words about Arifura Ventures?
Sure, thanks. Good afternoon, everyone. I, like you, started my career as an entrepreneur and had, built and sold a couple of companies. And the reason I wrote the book was because I didn't have a roadmap of how to raise venture capital many years ago. And, there's still today, there's not that much information out there. You build a product and then you want to get venture capital, so you have to learn, and it's usually by mistake. And so we're just trying to put, we sort of broke down 20 successful startup pitch decks and speak to them. And, so I spend my time investing in, predominantly B2B SaaS companies. We're based here in Palo Alto. And so we, put into about each company about $1 million. So, I always say I'm almost like the VP of the A round. We're post-seed investors. So we get in, roll our sleeves up, and help, hire, help with product. Usually it's 2 or 3 or 4 people in the company when we invest. So, we almost immerse ourselves and become part of that team for the 24-month to the A round. So that's a little bit about us.
Great, thank you so much, Mark. And Gadiel, can you just say a little bit?
And I'll just absolutely. Thanks, Erica. So Early Growth Financial Services, we are an outsourced accounting firm headquartered in Silicon Valley, San Francisco. We specialize in kind of 4 different service areas: tax return preparation, filing, consulting, 409A valuation services. And really the meat of the business for us is the day-to-day transactional accounting on an outsourced hourly basis, along with our CFO consulting services. And we work with many companies, early stage, mid-sized companies in the technology field, as well as other industries and areas. As a firm, we are at about 100 folks now, with 28 CFOs, about 65, 70 senior accountants, and a little over 450 active clients throughout the U.S. We have a physical presence in New York, Chicago, Seattle, Boulder, Austin, LA, and the Greater Bay Area. And I run the business development team here and work closely with many of the clients that are actively fundraising. We see a lot of companies coming out of incubators, accelerators. They engage us for help around pitch decks, executive summaries, and financial modeling and projections. And so at that point, helping them grow and scale and providing potential introductions to folks like Mark is a key part of our business. And that's why we really value the relationship we have with Mark and his firm. And he does a tremendous job really communicating the VC's perspective to many of our clients that we work with. So Mark, thank you very much for joining us today. I'm excited to have you and excited to go through this.
Yeah, and I got off the call this morning, Gadiel, with a guy who, it's got a company. They got 300 paying customers. And one of the things that he asked, which is a question I always like from entrepreneurs, is how can we really help and not be afraid to ask the VC that? I think most VCs, there's one question always asked the VC is, how can you help me? Even if they say no, and by design, you're going to get a lot more no's than yeses. So you've got to be prepared for the negative and always take something out of the meeting. So, I think what you want to look for in VCs is those that have your questions prepared. Be ready for people to say no, and ask them why, and just be really constructive. And I used to get quite upset, actually, and I know a lot of entrepreneurs do, because you put your sweat equity, your money, and opportunity cost into it, but you are going to get no's. So just be prepared to ask those questions, because the good VCs will give you pretty much straight answers, because that's what we like to do. You're aware that VCs like to give quick no's, and they do that because they respect your time. But whilst you're getting a quick no, remember we all like yeses, us too. But just be prepared to ask them why they've said no, because it's always a considered conversation internally. We're looking at various things and discussing them, and so you really want to sort of tease that out of the VC and then correct them or take them into your next pitch, so you've got an answer to the negative that was in the previous conversation. So, yeah.
Mark, it's funny that you say that. I've noticed that, especially when I send companies or potential companies that are fundraising your way, is that you are very thoughtful in responding both with a yes, I'll take an introduction, and then more importantly, when you do pose that no, is providing some of that feedback for the company, whether it's it's just not the sweet spot for our investing focus. The other aspect of being like, here are some of the concerns that, we have around that specific space or that industry. Or frankly, a lot of companies, just don't have enough traction yet. So I think those are all considerations from an investor standpoint, but I think it's great feedback, and the entrepreneurs and founders, and that's a point that I always push along as well, is getting that feedback is very, very valuable, and it really shows you what you can do to improve and work on before approaching that individual again or approaching other individuals. I think taking something out of each of those meetings can be incredibly valuable.
Yeah, and take notes, guys. I mean, and ladies, entrepreneurs, take meticulous notes, right? If you're working in a corporate, which a lot of you have, you go to a meeting, you've got your notepad, and you take notes, right? Who am I meeting with? What's the date? What are the action points? What was discussed, right? And I think the same goes with we do it. Like, I'm often on calls. I've taken notes. I look up the notes that I spoke to the entrepreneur 12 months ago. They gave me a forecast. They gave me some milestones, and I asked them, did they hit it? And usually I'm in a better position with the information than they are. So I just think it's really important to take those notes. And then also, Gadiel, my point is that a lot of entrepreneurs will, they're not really listening. I mean, if I can kind of just say that, they build themselves up and they pitch. You've got to be really, when the VC talks, really listen, because we often just make a sort of a short, simple statement because we don't want to go into a lot of detail because, we're not at liberty always to, give a lot of our insights, usually from time, but also just, our experience. So that aside, also with VCs, it is expected that you do give a considered, at least verbal response, if not a written one. I mean, I don't particularly like it when other VCs in deals we're involved with say, like, we don't have the bandwidth right now, or, I've declared email bankruptcy, or, it's we don't have the expertise. I think you've got to provide the entrepreneur with something because, of course we don't know, right? I'll tell you this story. I'm at Sequoia meeting with Mark Kwame, who's on the board of LinkedIn a number of years ago. I had this hot gaming company we wanted them to co-invest in, and he said to me, what do I know, right? Like, I passed on the investment round of Zynga when it was $10 million, thinking it was overvalued. So, don't ever think that investors have this, this crystal ball and they know everything. So, anyway, just some thoughts there for you to consider on, Q&A with VCs.
Sure. So we have some questions starting to come in here. So first, excuse me, I just went all the way around. I hope I don't make anyone motion sick as I page through this deck here, but this can maybe sort of position ourselves and situate ourselves. These are some of the key slides in the pitch deck that are outlined in this presentation. And we've already received some questions about, people are saying they would like you to actually go through all this content. And for you folks, I would just say, if you're interested in hearing Mark walk through all of these slides, we do have a presentation he's given before that does that. And I will include that link in tomorrow's follow-up email so that you can get that full picture. But for now, we have a few questions. So I'll just jump to the appropriate slide if it makes sense, or we'll just stay here to situate ourselves. So the first, you already sort of answered, but I'll ask it more directly. You were saying it's annoying when entrepreneurs don't really listen. So Greg wants to know, what's your biggest turnoff when it comes to entrepreneurs? What's your biggest pet peeve? What are they doing wrong that you wish you could tell them they should stop doing?
Oh, wow. I'm biggest pet peeve, Greg.
If listening's the answer, that's fine. Just wondering if you wanted to elaborate on that, or if there are some other things that he wants to know. Other things that you.
Look, I guess you want to do the homework on the VC beforehand, right? We've all got LinkedIn profiles. We've all got a history which is documented online. We've all invested in companies, right, that have done well, haven't done well. I think you want to draw a connection between either our personal history, our professional background, where we've worked, what we've done, or the companies we've invested in. And because we're designed, apart from the money, we're designed to help you. And I think that you want to tell the VC that you want them involved because, sure, we can write checks, but we can also do other things. We're all inclusive, gregarious people, right? We want to be part of your company as much as you want us to get the money. So I think, that's when I don't hear that from an entrepreneur, probably at a personal level, I kind of think, I don't want to be shut out, particularly at the stage we invest. Later stage, you can attend board meetings and make sure, things are expanding. But, in the explosive growth phase where micro VCs invest, we want to help. We're not, a lot of us aren't MBA bankers that don't have operational or entrepreneurial experience. So that's probably one of them, Greg.
Great. Do you have anything to add, Gadiel, of anything that you've observed that you think, gosh, I wish that the founders we worked with would know not to do this. It just doesn't go over well.
That's a good question, Erica. I wonder, and maybe I'll pose this question to Mark. You mentioned doing some homework before you're talking to the VCs. Is it an annoyance to get an inbound, request for a meeting from a company, and they clearly haven't, they don't know what your investment focus is or what your investment thesis is, and it's a company that's kind of, let's say you don't invest in any clean tech companies, and so it's a clean tech company reaching out to you and saying, hey, I'm looking to raise an A round, and you're clearly seed investment stage, and re-up in the A round. I mean, is that a turnoff? I mean, that's one of the things that I advise companies to do is, hey, here's a list of folks, but make sure you're talking to the appropriate partner within those funds to make sure that you're aligning yourself that way.
I think spot on. I'm amazed, everyone, how many VCs there are out there that I haven't even heard of, right? I mean, I subscribe to various, venture capital alerts, and I think, two things. You can set up Google alerts on your competitors or companies that are in your, realm, and then look at who's funded them, because they're probably not going to fund you, right, or your company, which makes sense. So that's a list of, a list of negative VCs you won't approach. I think you also want to look at companies or VCs that, if you've got a new tech, and then explain to them in the email why they should be looking at this. Let's use an example, drones. Probably got 30, 40 drone email, presentations from founders saying, hey, but no one's actually told me, why we should invest in it. And I think you want to make that connection. So I think, everyone, Gadiel and I will often introduce, startup companies or companies in our portfolio to each other. And I think that there's just got to be a consideration before the email gets sent out. I say this to a lot of folks, and I'm one of them. I moved from Sydney, Australia to America here in the Bay Area in Palo Alto 15 years ago. Not by accident, but by design. You have to put yourself in a position where you can network, where you can meet people and try and email introduction cold is hard. Another couple of ways you can do it is, stage tackle VCs after presentation. And if you don't flood them with, war and peace on your company, perhaps a business card with a 1-line, 2-line elevator pitch. LinkedIn is more personal. Like when I speak at conferences, if I get a LinkedIn saying you said something and it really, I identified with it because, and I'd like to have a look at the company, at least there's a tenet of, there's a comparison that I can draw. They've heard something I've said, or a blog post or a video or something. I feel that that's really important. That's just human nature, right? If a VC's blogged about something, a lot of VCs have blogs. I don't because of the book I tend to just stick to that. But a lot of VCs blog, and you can, comment on the blog. You can also tweet them, right? Follow them, see what their pattern is. So I think there's just a lot of ways, Gabrielle, other than sort of a cold blanket email or submission form to get the VC's attention.
I completely agree with you there, and that's something that whenever I'm meeting with companies, I always share with them. Here are some of the relationships that we, as a service provider and as a partner in their business, bring to the table, and I strongly recommend that they do the same thing with the other folks that they're working with. And frankly, another powerful ally for early stage founders and entrepreneurs are other founders and entrepreneurs. And to your point earlier about looking at the portfolio of companies that VC is invested in, reaching out to those founders that and getting a connection that way, that can be hugely valuable.
Yeah, you're just going to have to do it, entrepreneurs out there. You're going to have to network, breakfast, afternoons, coffees, and find people. A warm introduction is much better. There's just no way about it. And if you're not a good networker because you're coding or you just don't feel like you've got the wherewithal, you're more of a backroom person, find a partner or find advisors, because that's really important. I mean, slide 10 in that pitch deck essential talks about advisors. And advisors can do a range of things, and finding someone who's really good at making introductions is really important as well. You want to definitely, ask people, if you're going to give them stock in your company, you want, as an advisor, you want to say, hey, I need 30, 40 introductions, right? So I think, that's a company called Storefront that's raised. We spoke to them when they had a couple of $1 million. And you'll see, I don't think you need to have rock stars on your advisor slide. You just need people that are helpful, right? That like you as a person, love your product and how you're disrupting a market or trying to change the world. And I think that is a really healthy way of getting introductions to VCs that matter.
I'm going to jump in here, Mark, because we have a couple of questions about advisors. So that seems like a good time to ask. So first of all, Julie had a couple of questions. First of all, she's asking if you should put the advisors on your management team slide to kind of fill out your management team. And also, how important are advisors? How did the advisors factor into your decision whether to fund a company or not?
Yeah, so I think they're really important. Because at a range of reasons. The first reason is that they, advisors actually help you as a person go through what's a fairly horrendous thing called a startup, right? It's definitely not easy, having one or two or three people that often, you just can't express your real emotions to, right? So I always say to people, advisors show that you're well-liked, you're respected, and VCs understand that you need to have, a cup of coffee, a beer, a shoulder to cry on, a long walk around the block, as much as someone saying, hey, I'm going to critique your product, introduce you to a channel partner, invite you to events. I think, advisors, seeing advisors on the slide, it just sort of helps if you don't have a big team. Look, from an equity perspective, we always say, advisors can be anywhere from a 10th to a 20th of 1% of the stock. We always like to, I structure a lot of these for portfolio companies. It's like, give someone, a tenth or 2/10 of 1% of the stock over 12 or 24 months with monthly deliverables. So whether that's, catching up for 2 hours to go through engineering roadmap or, 20 introductions or help with sales calls or hiring, I think it's, it's just wise to ensure that your advisory agreements have deliverables, right? because I feel that if you don't have those deliverables set up, you can have a bunch of great advisors that are busy running their company. So advisors aren't just there as investment deck eye candy for investors. You want to make sure that they are helping you grow the business. So yeah, they're my thoughts. Erica.
Okay, great. And we have sort of a related question here from Phaeton. You kind of referenced that you can use advisors to fill out your team if you have a small management team. So Phaeton has a couple of questions. One, and I'll take them one at a time. So one is, how vital is it to have a technical co-founder?
This is a most frequently asked question, isn't it, Katia? And I am one of those.
Absolutely.
I didn't have that co-founding CTO, so it's pretty hard when you don't have one. I think most of the time I see companies, startups struggle without one. That said, I'm thinking of a company in the Bay Area that struggled through a couple of $1 million of rounds without one. I think in front of the investors, you've got to be able to point to one of your engineers and say, I don't have a CTO, but I've got a lead engineer, because who's managing the product roadmap? It's not just what you've built to date, which might be version 1, version 2. It's they're investing in the future, and that future's got to include product revisions and upgrades, and because that ties into defensibility and scalability. So look, you're not always going to have a rock star CTO, like on the slide there, from PayPal worlds or Microsoft worlds, but you do have to be able to point to someone and say, this guy's in charge of our roadmap, and he's going to get us through. And then we're going to employ or put someone on, and that's why we're raising the money. But whether that's VP product or CTO, I wouldn't get hung up on the title, but I definitely you're in a much better shape going into pitches when you've got the tech lead, let's call it. So it's not critical, it's an advantage, but definitely you've got to have someone you can say that's the lead person.
Mm-hmm. Gadiel, do you have anything to add to that?
No, I think Mark's dead on. Having a member of the team in that capacity is what you need. There are, I do know of a few angel investors out there that, when I have conversations with them, they flat out say, if there's not a technical member on the team, I won't talk to that company, because I need somebody who knows what they're building to really be able to, faithfully invest in that company.
Okay, interesting. Yeah. So, and Phaeton, that kind of ties into this too. Phaeton had a follow-on question, which is, how important is this beginning team anyway, when, in their mind, many players may change as the company grows, and some of the original team members may end up being replaced with even better talent. So what are your thoughts on that?
I just had a further thought on the tech person.
Sure.
We always do that. Usually on the first pitch, you may not get into what's under the hood, what the product, the mechanics of it and how it works and scales. But, you move through various rounds of conversations, you're going to get into, product due diligence. And I was at a lunch last week, and, the entrepreneur was telling me that, the founder of Mint.com was doing, interviewing engineers, right, of an investment, right? So, you do find, the partner at the VC firm or the associate or one of the, angel investors is a high-profile, credentialed tech person, and they will be interviewing the folks as part of the due diligence, in addition to reviewing the product, right? So then, they're not always just focused on the product that's built, but the talent behind on the team that is going to build the next revision, next version of the product, right? So often due diligence is not just on the existing platform or the mobile app, or the servers or the technology. It's the people that are going to build it. So, and then could you just repeat the question as well?
Yeah, absolutely. Phaeton is asking, how important is the beginning team when many players may change as the company grows and some people may end up being replaced with better talent? I mean, it's sounding like that's the opposite of what you're saying. It seems like what the idea may change, the product may change, but the team is still going to stay the same, and that's what you look for as a good team, right? Or not?
Right. Yeah. I mean, it's definitely going to change, and so the team is critical. Yeah, so team is critical in the early stages. However way you cut it, it's just really, really important. I think at the end of the day, we can see the product working, and maybe you got some customers that, we take the leap of faith more so into the team's ability to execute, right? Or let me say, the team's ability to recruit. So without having that, tech lead or strong sales lead or operations lead, you're not going to be able to recruit the talent, because those talent end up leaving their existing job, because they believe that you're a smart, talented person that can, advance their net wealth and, skill set and livelihood beyond what they can in their current position. So, it's cumulative, but it's pretty hard. I've seen it's pretty hard for, a sales product, non-tech CEO, founder, to recruit lead engineers that are really good, as opposed to those that are, product tech engineering guys recruit other great product engineers.
Do you want to add anything to that, Gadiel?
No.
Okay.
That's all great.
Okay, great. We have kind of a related question here from Diana, if I can parse this. She's saying, so as opposed to like the management team changing, we're saying, the business is going to change. So she's saying for seed stage companies where the business model will likely change, how detailed do you recommend being about the plans? Given that they're going to likely change during the MVP process after a prototype's built, and how upfront should you be about all that?
I think there's two types of, entrepreneurs, as I've found. There's those that, under-promise and over-deliver, and then there's those that, over-promise and under-deliver. We tend to like the former. I think you want to say, am I the type of person that promises and doesn't deliver? And if you are, promise less and deliver more. Because, we always, we work on the principle, most VCs, it takes longer and it costs more money, right? So let's just start with that as our expectation of investing in a company. They say they're going to hit those milestones and do those quarterly sales and get to those number of downloads, but they're not going to, because they're enthusiastic, they're optimistic, and we're a little more realistic and perhaps pessimistic, right? Regardless, things happen, and you often don't hit those milestones. So I would sort of think about it this way: just be very clear with venture capitalists on what your milestones or your metrics are. Put a little bit of, wiggle room into it, whether it's 1 or 2 months, or whether it's, but don't just be overly aggressive if you don't have historics to back it up, right? And then just say, you've got to show that there's a big, 5-year opportunity. But I wouldn't just put ridiculous numbers and milestones in the first 18 months, because we just look at it and say, well, yeah, they can be optimistic, but it won't happen. And then I just think your reporting is really important. Like, probably the biggest thing where entrepreneurs fail is they report late particularly in the post-seed stage, they report late and they don't provide enough insight into the reporting. And I think that's the point is you want to communicate your metrics, your milestones, the good and the bad, not constantly, like every 5 minutes to VCs, but whether it's, at least monthly, because then we understand what the levers are in the business. Oh, you won a big contract here, you lost the staff, like things like staff are sick, we didn't hit our quarter, right? Or, there was an outage, or just these small material things matter. So I would be less focused on trying to show, astronomical figures and more focused on saying, here are the 5 metrics or 7 metrics I'm going to report on that run our business, and I'm going to report on a timely basis, because that's how you build trust. And that's what you really want to engender with the venture capitalist, is not, proving that you can get to 1 billion users in 6 months. It's all about, no, I'm going to report consistently and transparently to venture capitalists. You'll get a lot further that way, and it'll help your business because you're not worried about shooting the lights out, because, you're doing what you say and engaging the VC and building their trust. So I hope that helps.
On that, yeah, a quick question on that end, or a little bit of an add-on, Mark. You mentioned kind of on a monthly basis getting the update from the company. How is this usually delivered? I think the formality aspect of, is it in a formal report, or is it more of, hey, here's an email update? I'm sure it depends by the investor on how they want to see that, but at the very early stages, and by all means chime in, but I would think that kind of an email update of where the business stands and some key metric points addressing those is probably sufficient, right?
Absolutely. Don't think the VCs want pages and pages. I agree, Gadiel. We most of us are numerically orientated, right? So whether it's unique users, number of downloads, churn, sales commits, sales trials, dollars per quarter, dollars per region, dollars per salesperson. These are sort of the top line things. Key milestones. And one of our portfolio companies has a great slide that says, it's the green, red, yellow. And it's like, what happened this month, which was great, what kind of didn't happen, and then where we need help. And I think, so keeping a top line, and so you can compare as well, right? Often you get, you'll get your monthly, and you go, okay, things look good, but how did it compare with last quarter? So whether that's budget variances, we always have our portfolio companies prepare a budget. The budget gets updated quarterly. All quarterly results, actuals are in one column. The variance to the budget is in another column, because often at the board level, you want to be able to say, not only did we hit our goal, right? We got 30% extra in sales, but the cost was 20% extra. It's a discussion point. We all know things move around, and I think providing that, forecasted versus actual allows you to talk very intelligently and matter of fact about your business, and it just shows that you've got your finger on the pulse. And the same with, and if you're not good at it, get guys like Gadiel and Erica's firm to help you out, right? Spend the money and get them to do the financials, because guys like us, we're making investment decisions based on, the numbers and the reporting being correct. You'd be amazed. Like little things like, how much cash do you have, right? We like to see cash waterfall charts. We like to see, icons of new customers that you've won, pictures and backgrounds, a little bit of, new staff members. So the board deck or the monthly reporting doesn't always have to be dry. It can be somewhat colourful. But yeah, getting a routine and a framework down on the reporting and sticking to it is really important, as opposed to, a series of sort of stories and descriptions. So I would err on the side of, or tend to focus more on quantitative stuff, and then a couple of slides where you're talking qualitatively about issues. But always leave room in the deck while you're reporting to seek advice and help. I hope that helps.
Yeah, so both you and Gadiel have spoken a lot about milestones, and so George wants to know: are there particular milestones that are more attractive to investors than others, or any milestone as long as you can show that you're setting goals and that you're able to achieve them?
George, I don't think I can remember an entrepreneur that sent me updated metrics. Entrepreneurs are great at saying, hey, we're cool, we've got our deck, do you want to invest? And if you say, maybe, and then they close their round, they often don't come back, right? You should always be raising money, even from folks that are initially say, look, we're interested, but it may not be a fit right now, because that's a soft no, not a hard no. So whatever you choose, you'll find based on your business, the top 3-5 metrics. There's no harm in sending those VCs you like or you want to invest in your company in latter rounds an update. There's a company in New York, actually, they're a marketplace, just got to 100,000 users. I really like the founder, but I don't think we'll invest. But I'm on his friends and family quarterly update, and I got to tell you, it's impressive, right? It's easy to do. You just add them to the email list of, investors or family or friends, and you update them. And I think over a period of time, you get more comfortable with them, their business, because they're educating you. So I think that's probably a little bit of a golden tip, because often it's not right for them, but you might introduce them to someone, and so just don't think the VC. We all talk, we're all sharing deals, we're all communicating every hour about different businesses, as entrepreneurs are, and so giving us an email that drops into our inbox, every 90 days, gives you the opportunity and gives us something that we can forward on to a VC we've been talking to or we've just co-invested with, to say, you know what, this is not for us, but this entrepreneur has proven that he can communicate effectively over a period of time. So it's not just about the metrics, it's about consistency of communication with VCs.
That's huge, Mark, and I really think that that's a very, very important point. That for instance, I had a friend who is actively building his startup, and he used to have just what he called his own quarterly VC roadshow. He'd go up and down Sand Hill Road and build relationships with investors, and it was basically an update on where his company stood and what where they are currently. He never actually asked any of the folks for money, but was more proactively asking them their thoughts, ideas on how to better build his business and grow the company. And his whole objective was, when he gets to that point that he is actively fundraising, that those conversations will be very easy. He's already got a relationship built with those folks. And then because he's been giving them these periodic updates, the actual pitch is going to be a lot easier. So I think that's a huge point. And then your point about VCs, and investors talk to each other, that's something that I've noticed a lot recently, and you've shared that a lot with me recently, that, bringing in other folks in the community just helps to add to, the success of the company. And also aligning yourself with the right folks is very important. And those people that are going to add value, truly add value to your company, is very important.
So we have a couple more questions here. Let's see. This is sort of about the language used to describe your offering. So we have questions. It seems like there's a fatigue of using vague terms like platform and marketplace. How do you combat this fatigue, or do you just continue to use these vague labels in describing what you're intending to build? Do you care what people are naming it, or more? It's more how they describe what they're doing?
I'm very comfortable with those terms. Marketplace, SaaS. I think it's important that you start there, but you dive into very quickly how you're different, what space you're creating, or what sector or subsector of a space. So let's take marketplaces, right? So, there's an open marketplace, right? Like, take Elance, Odesk, those sorts, eBay. They're marketplaces. And then you've got, supply side marketplaces that are closed. You've got demand side. You've got marketplaces with demand side tools, or, SaaS components of it. So I think it's pretty important. But no, I don't think that, just because, let's take the payment space, right? It is what it is. I just think very quickly you want to sort of, dive into how you're different, or how the market is changing, or that segment's changing.
Do you have anything to add to that, Gadiel, or?
No, I think we can move on.
Okay, okay, great. So let's see. We have a question from Yun about the competitor matrix, and she wants to know, how comprehensive does your competitor slide have to be? Like, are you really listing every possible competitor?
Yeah, we can go to that slide. Who's the lady that asked that question, Erica?
Yun.
Who asked that question?
Yun, Y-U-N, Yun.
Yun. So, just a couple along, actually. I think it's slide 9. So here's the rub, right? You do that work, or we have to do that work. And either way, we'll find out very quickly, right, by typing in, the words that describe your business into Google with the word competitors, right? Collaborative software competitors, right? Mobile payments competitors, right? List of SDK apps for, crowdsourcing. Whatever it is, we can very quickly, thanks to search engines, find some companies that are in your zone. With the risk, if you don't put these competitive matrix together, we draw our own conclusions, which is dangerous, right? Like this morning, while the entrepreneur's on the phone, I'm typing into Crunchbase and TechCrunch the name of the space that his company was in. And while he's telling me he's got no competitors, I found 4 that were funded. And so that's the risk. We'll find them anyway because, desktop research is something we're pretty good at. And then if you click to the next slide, Erica, what we want to know is where you're different. We're not concerned that there are competitors. In many ways, it validates the market. Oh, Andreessen invested in this space, or, Salesforce Ventures. Oh, that's really interesting. Why did they do that? And that kind of validates. So I think competition is a good thing, but you want to show how and why you're different. So it's a really good talking point. In terms of competitive matrix, into an advantage, saying, you know, we're not all things to all people. We do have these features and functions that are unique, and that's our point of difference. And I think that you're going to get a lot further faster in a meaningful way with investors if you put a thorough competitive matrix together.
Yeah, I think that's right, Mark. And I think to your point, you know, I think it's identifying a couple of key players. I don't think you need to go super deep in the weeds in terms of identifying your competitors. And I think understanding the marketplace or the space where you're playing and where you're competing and understanding some of the key differentiators, that just helps the investor understand the business more. And, you know, they're going to go out and do their own diligence anyway, but at least this way, you're being transparent about your business and understanding what the competitive landscape looks like.
Great. So speaking of going into the weeds, we have a question here from Marcus, and he wants to know about, you know, when you're talking about your product or your technology, do you want to demo it, and how deep should you go into a demo?
Yeah, good question, Marcus. Erica, can you just go back to slide 3?
Sorry, I'm a little lost here because they're not numbered. What's the heading on it? Sorry, this one. Okay, gotcha. Sorry about that.
Yeah, that's perfect. So what you want to do, Marcus, is, you know, after the introduction and the problem that you're solving, you say, hey, here's our solution, right? So you want to give a visual in the deck of your solution, right? Whether that's a screen grab of, you know, what you're seeing here, because the deck often gets passed around to investors. Right now, we're evaluating a company that's got a video, and, you know, it's great because we can see the product on the video, but we can't actually see to play with the product. So you want to demonstrate. I think in the ADD world that we live in, you know, the demonstration should be sort of 60 to 90 seconds. I think in the initial pitch, you want to keep flowing. You don't want to get caught up. No one wants to see a 10-minute demo. We don't have the time if we've got 30 minutes. You know, what you really want to do is say, you want to show we've built something. You want to demonstrate this is not smoke and mirrors. It's not a screen grab. It's not a mock-up we did. This is actually a real. We've logged in. You can download it. You can interact with it. And so definitely you want to segue from this slide into a demonstration, whether it's, you know, logging in and clicking around inside an application or showing how it's installed. But you don't. That's really just to show the VC that, okay, we've spent some of our time or we've built something. If you haven't, well, you know, it's an earlier conversation and you can't. But the right time to do it is around slide 3. And I give yourself 60, 90 seconds with the follow-on with, look, happy to take you through a deep dive into the platform or the tech or, you know, what we've built, but let's keep moving on because, you know, that's a follow-up conversation for a different meeting.
Great, thanks. Gadiel, do you want to add anything to that, or?
I actually have a question for Mark. Mark, you know, when you receive a potential introduction or incoming, you know, deck and executive summary, what do you like to see? Is it, you know, the standard, you know, how you identify very nicely the standard pitch deck and then a 1 to 2 page executive summary? Do you, you know, if a company submits a video demo or things like that, are those valuable as well, or do you want to save that for the actual in-person meeting?
I think everyone's different. The 1 page is tough for me. I'm more of a visual person. I would prefer to see the deck than a 1-pager. Because you've got the attention span of the venture capitalists for, you know, what have we got? A minute or 2. And I just think asking them to read a one-pager with market opportunities, I mean, it's just all bullet points. It's tough. So I tend to I prefer to see a deck. And I get some of our portfolio companies that are raising money to do 5-slide decks. So if I'm sending it around to other VCs saying, hey, you know, one of our companies is doing an inside round or another funding, are you interested? I don't give them the whole deck. I give them, 5 slides. So I just think the visual impact, that first impression, is critical, right? Whether that's you look at maybe click through to that first or next slide, Erica. Show kit, the next one, sweetness, right? If I open the document and I see that compared to a one-pager that's black and white, which one are you going to want to think, wow, I want to look at more, right? So the one page is meant to be an invitation to learn more. I often think it's a turn-off because it's just like opening up a book of a, 16th century encyclopedia. It's like, whoa, where do I start? Video is totally interesting because, we invested in this company recently that had an awesome video. And the first thing I saw was the video. I'm not saying that, that influenced the decision. It got me to the next stage of, I'll have a look at the deck or meet the CEO. I guess, a lot of these Kickstarter, crowdsourced, Indiegogo type campaigns are dragging video forefront, right? I was looking at Cuff last night. If you haven't seen Cuff.io, they raised $5 million recently. The video on the homepage is amazing, right? It's what it's doing. It's emotional. It's not about, wow, big market, great team. Kind of looks like an okay product. Sort of interesting. I'll follow up. Yeah, I'll take a meeting to, I can see the product working. I can see the use case, and I'm emotionally dragged into it. So, Gadiel, last week I was with a VC that's, critiquing the videos of companies that he's funded, and talking to me about, the emotional appeal, how the, video is great. In 46 seconds, he can demonstrate the product, talk about price point, talk about functionality, emotively grab people. And I'm like, that's smart. So, with all these tools at entrepreneurs' disposal, I wouldn't discount video. I think it's for the smarter entrepreneur, it's a great way to do it.
Thanks. So that takes us to the end of the hour here. And I actually think that's kind of a nice note to end on. Sorry, someone's asking, can you say the URL one more time for that website? Is it cuff.io?
It is. Yes.
Okay, great. So I think that's kind of a nice way to conclude here, because, what you said is about the idea of a good video takes you to the next step. And I think that's the whole idea of what pitch decks are supposed to do, right? This whole process of pitching just takes you to the next step.
Right.
So.
Yeah, and on video, everyone, video is, it allows you to be scripted, right? You got to write a script for a video. Then you got to choose the visuals. I've got to buy video backdrops from Shutterstock or, iStock Photo or Fotolia. And then I've got to, put messages in. I've got to script my pitch. And so, what the video really is, that minute video, it is, and often people do it brilliantly after they've launched, but, we're seeing companies do the video because it just cuts through and it drags investors emotionally into it. So, maybe that's something you consider.
Yep. Or if not, it's still, the point is your pitch is going to take you to that next step. So thank you again. For people who are asking me to repeat it again, it's Cuff, cuff.io. They're going to get a lot of hits on their website. Okay. So So here we are. We have contact information up here for both Mark and Gadiel. So if you do have any outstanding questions, feel free to follow up with them individually. We'll be sending out an email tomorrow with a link to this recording and the deck. And I'll also throw in the link to the previous recording of the presentation where Mark walked through all these slides, so you get a more comprehensive look at them. Just a quick plug, this is a big webinar week for us. We have 2 more great webinars later on this week. Coming up on May 13th, we have Is Your Business at Risk? 10 Tips to Manage Risk and Maximize Value with Mary Jutin from Tracklight. Doesn't sound as intrinsically interesting as this one, but I guarantee it's going to give you lots of food for thought. And then on May 15th, we have Accounting for Startups, What Founders Should Focus On with Ryan Johnson from Early Growth Financial Services. So if you want to sign up for these or see any of our other upcoming webinars or events, you can just check out our site and click on the events page. Again, Mark and Gadiel, thank you so much for your time. I think this was really useful, and I hope everyone on the call got a lot out of this. And you know, it's a great opportunity to have you speak with us, Mark, and we always appreciate having you on. And thank you and Gadiel for your time.
And thanks, Erica, Gadiel. Yeah, I always learn something new anyway. So thanks for all your questions, and good luck, everyone.
Okay, thank you. Take care, everybody.